Welcome to our explainer. Today, we are digging into a really interesting analysis that claims a massive, behind-the-scenes war has just erupted in the silver market. So, is this just business as usual? Or, as the source material argues, is it a highly calculated raid on the world's physical supply? Let's dive in and take a look at the evidence they've put together. So this is the number that really set off the alarm bells. In just the first 48 hours of 2026, a truly staggering 17.2 million ounces of physical silver were suddenly demanded for delivery from the COMEX exchange. And let's be clear, we're not talking about some paper promise here. This is a demand for the real thing, the actual physical metal. Now, to put that number into perspective, in just 2 days before most folks were even back from their New Year's holiday, a demand was placed for 2% of what the entire planet mines in a whole year. The analysis argues, look, this isn't some factory just ordering parts. This volume, this timing, it looks like a sophisticated and very coordinated raid on the physical inventory. So what are we really looking at? According to this analysis, it's not just a market event. They're calling it a crime scene. The central claim is that the evidence points to a massive transfer of real wealth between banking giants. All right, let's walk through the evidence they've laid out piece by piece. So who are the players in this raid? Well, you might think this was, a bunch of small investors getting together. But the source says, nope, this wasn't an attack on the system from the outside. They argue this was an attack from within it, a sign that the old alliances on Wall Street are completely breaking down. The analysis actually uses the word cannibalization to describe what's happening. The argument is that the unspoken truce between the big banks, that sort of gentleman's agreement to keep things stable, well, that's over. In a resource crisis, it's every institution for itself. And here's where it gets really interesting, because the source names names. On one side, you have the seller, Deutsche Bank. The analysis uses some really strong language here, saying the bank was forced to, and I quote, vomit up over 3 million ounces of silver. And on the other side, you have the buyers, JPMorgan and Citigroup, who the source claims smelled blood in the water and moved in for the kill. But why now? I mean, what changed to make this happen? Well, the analysis points to two critical factors that created a perfect storm for a physical resource grab. It's turning the silver market into a high-stakes game of musical chairs, where the actual metal is disappearing fast. First, you've got the trigger. A new policy out of China effectively just turned off the faucet for silver flowing from the east. And according to the source, the Western banks saw this coming. They looked at that last pile of 39 million ounces sitting in the COMEX vaults and realized it was the last major, easily gettable stockpile in the world. The race was on to claim it. And this chart right here, wow, it really paints a picture of the core problem. Between New York and Shanghai, the exchanges are draining a combined 4.5 million ounces of silver every single day. But the world's mines, they're only producing about 2 million ounces a day. You don't have to be a math genius to see that's just not sustainable. We're burning through it more than twice as fast as we're digging it up. Now, this situation is reportedly happening in China's market. It's a condition called backwardation. Basically, factories are so desperate for the metal today that they'll pay more for it right now than for a promise of delivery next month. The source calls this the heartbeat of a squeeze because it shows that trust in the future supply is completely collapsing. Okay, we're about to get into how all of this trickles down to Main Street. But real quick, if you're finding this analysis useful, please take a moment to like, share, and subscribe to our channel. It really does help us out and ensures you won't miss any exciting updates. So why does a battle on Wall Street matter to you and me? Well, the source connects this high-level raid directly to the supply chain for everyday buyers. They argue that the fight over those 1,000-ounce bars and bank vaults is the reason you might not be able to find a 1-ounce coin online. And this is what they're pointing to. This is reportedly the message you'd see on the website of a major U.S. dealer, SD Bullion, if you tried to buy this year's American Silver Eagle, one of the most popular silver coins in the world. The shelves, according to the source, are just bare. And it's not like you can just check back tomorrow. The analysis highlights that a customer trying to buy in early January is being told to wait until March. That's nearly a 2-month blackout on new inventory, which the source says is because the U.S. Mint itself can't get the raw silver it needs to make the coins. This whole situation creates what the source calls a bifurcation, a split in the market. Essentially, there are now 2 different prices for silver. As you can see, the big banks, they get the metal at the wholesale price, about $71 an ounce. But the public? Well, they're paying a huge 25% premium on top of that, a retail tax, as the analysis calls it.
So you have to ask, did this big raid bankrupt the banks? Was this a sign of financial weakness? Well, the answer the source provides is, in its view, actually a lot more frightening than that.
That whole $314 million raid reportedly cost JPMorgan and Citigroup just 0.02% of their combined capital safety buffer. The source says, to put that in perspective, it's like you or me buying a single cup of coffee. For them, it was a financially insignificant move. And this brings us to what the analysis calls the crucial point of this whole thing. The banks don't have a money problem. They can get all the dollars they want. The problem, according to this source, is a coming lack of physical silver. The analysis claims that the banks are converting what it calls worthless paper fiat into a hard asset. The issue isn't the price, it's getting the metal itself. The analysis argues that JPMorgan has been playing a long game, and they've just moved to the final phase. For years, step one was to help keep the paper price low to buy up massive physical stockpiles cheaply. Step two, the pivot, is happening now. Their vaults are full, so they drain the rest of the market. And step three is to profit, letting the price rise, which revalues their own huge holdings. So what's the final takeaway from all of this? According to the source, the fundamental rules of the silver market have just changed. The old way of doing things might be over for good. The source claims the era of playing games at the paper price is finished. The new game is all about hoarding physical metal, because that might be the only thing that matters when the dust settles. And in a strange twist, the big banks are now playing on the same side as individual holders. Everyone just wants the physical. So the prediction is that this raid is going to trigger a global resource panic, starting the moment markets reopen. They're expecting a violent market open Sunday night as Asian traders react to the news. Then, next week, the banks themselves might start pushing the price higher. And long-term, the real price won't be decided by paper contracts, but by who's actually holding the metal. And so the source leaves us with this final thought. Forget all the commentary and official statements. According to this analysis, the actions of the biggest players signal a deep loss of faith in paper currency and a mad dash into hard assets. It suggests we shouldn't watch what the banks say, but watch what they do. And right now, what they're doing is buying every ounce of physical silver they can get their hands on.